Let me tell you about the most expensive mistake I have ever witnessed someone make with gold. A buddy of mine, let us call him Raj, bought 10 ounces of gold coins back in 2019. Paid about $19,000. Smart move, right? Gold was around $1,900 an ounce, and look where it is now in 2026, hovering around $4,700 to $5,000. That is a monster gain on paper. Except, Raj did not actually make as much money as you think. He paid a 5% dealer premium when he bought, an extra $950 gone on day one. Then he needed a safe, $800. Insurance, roughly $150 a year. And when he wanted to sell 2 coins last year, the dealer offered him 3% below spot price. By the time he added up every fee, premium, and year of insurance, his real return was almost 15% less than what the raw gold price would suggest. 15%. That is not a rounding error. That is a vacation. So here's the question nobody asks loudly enough. If you want long-term exposure to gold and silver, if you believe these metals have a place in your portfolio for the next 10, 20, 30 years, is there a better way to do it than buying the physical stuff? The answer is a resounding yes. And it comes in the form of 2 specific ETFs that I'm going to break down for you today. Not 10 ETFs, not a complicated matrix of options, just 2. One for gold, one for silver. And by the end of this, you are going to understand exactly why these 2 funds exist, how they work under the hood, what they cost, how they are taxed, and most importantly, why they are a better deal than hiding shiny metal in your basement. Before we get to the specific ETFs, though, we need to talk about why gold and silver even deserve a spot in your portfolio in the first place. Because if the answer is no, then none of this matters. Gold is often called a safe haven asset, which is a fancy way of saying it is the thing people run to when everything else is falling apart. When stock markets crash, when inflation eats away at your dollars, when governments do something unpredictable, gold tends to hold its value or even go up. It has done this for literally thousands of years. The ancient Egyptians valued it, the Romans hoarded it, and central banks around the world are still buying hundreds of tons of it every single year. In 2025 alone, gold surged roughly 64%, one of its best years in modern history. Central banks globally purchased over 900 tons, and Goldman Sachs, JP Morgan, and several other major banks are projecting gold could hit $5,000 or even higher by the end of 2026. Silver, on the other hand, is gold's wilder, more unpredictable cousin. Silver is both a precious metal and an industrial metal, meaning it gets pulled in 2 directions at once. People buy silver as a store of value, just like gold, but silver is also critical for manufacturing solar panels, electric vehicles, smartphones, 5G electronics, and medical equipment. About 58% of all silver demand comes from industrial uses. That dual identity makes silver more volatile, meaning it swings up and down more dramatically, but it also gives silver an extra growth engine that gold does not have. In 2025, silver prices surged roughly 140 to 150%, massively outperforming gold. Many analysts believe silver still has significant room to run because it has not come close to its inflation-adjusted all-time highs when measured against the total money supply. So the case for owning both metals is strong. Gold gives you stability and crisis protection. Silver gives you that same precious metals hedge plus industrial upside. Together, they form a diversified precious metals allocation that covers multiple scenarios. Now, the question is how you own them. And this is where our 2 ETFs enter the picture. The first ETF is the SPDR Gold Shares, ticker symbol GLD. This is, without exaggeration, the single most important gold investment product ever created. Launched in November 2004 by State Street, GLD was the first U.S.-traded ETF backed by a physical asset. Before GLD existed, if you wanted gold exposure, you either bought coins, bought bars, or messed around with complicated futures contracts. GLD changed everything. Here is how it works, and I promise this is simpler than it sounds. GLD is what is called a grantor trust, which basically means the fund holds actual, real, physical gold bars in secure vaults managed by HSBC in London. When you buy a share of GLD, you are buying a tiny fractional ownership of that pile of gold. Each share represents roughly 1/10 of an ounce of gold. So, if gold is trading at around $4,700 per ounce, one share of GLD trades around $413 to $470 depending on the day. As of March 2026, GLD manages approximately $184 billion in assets, making it one of the largest ETFs on the planet, not just in gold, but in all of investing. The daily trading volume is enormous, typically over 14 million shares changing hands, which means you can buy or sell GLD in seconds during market hours with virtually no slippage. The spread, which is the tiny difference between what buyers are offering and what sellers are asking, is typically just a few pennies per share. Compare that to selling a physical gold coin, where you might wait days to find a buyer and lose 3 to 5% off the spot price. Now, GLD charges an expense ratio of 0.40%. That means for every $10,000 you have invested, you pay $40 per year in fees. Is that cheap? Honestly, it depends on your perspective. Compared to storage plus insurance costs for physical gold, which can run $150 to $500 per year for the same amount, GLD is significantly cheaper, especially for allocations under $50,000. But compared to some newer, lower-cost gold ETFs, GLD is actually on the pricier side. The SPDR Gold Shares, ticker GLDM, charges just 0.10%, and the iShares Gold Trust Micro, ticker IAUM, charges a razor-thin 0.09%. So why am I recommending GLD over those cheaper options? 2 words: liquidity and size. GLD is the most liquid gold ETF in the world. When markets are panicking, when gold is spiking or crashing, when you absolutely need to get in or get out right now, GLD's massive trading volume means you will always find a buyer or seller at a fair price. During the flash crashes and volatility spikes we have seen in early 2026, smaller ETFs sometimes saw their spreads widen significantly, meaning you could lose more on the trade execution than you saved on the expense ratio. For long-term passive investors who plan to hold for decades, that liquidity premium is worth paying. Think of it this way. GLD is like buying a house on a busy main road. It might cost a little more per square foot, but when you need to sell, there are always buyers walking by. The cheaper alternatives are like buying a house on a quiet back street. Great deal on paper, slightly harder to unload when you need to. That said, if you are investing relatively small amounts and you plan to buy and hold for the long haul without ever needing to sell in a hurry, GLDM at 0.10% is a perfectly fine alternative. There is no wrong answer here. Both hold physical gold. Both track the same price. The difference is just in fees versus liquidity. The second ETF is the iShares Silver Trust, ticker symbol SLV. Launched in April 2006 by BlackRock, SLV does for silver exactly what GLD does for gold. It holds physical silver bars in secure vaults, and each share represents a fractional ownership of that silver. As of March 2026, SLV manages around $33 to $46 billion in assets, depending on when you check, because silver's price has been on an absolute roller coaster. The expense ratio is 0.50%, which is higher than GLD's fee, and that is partly because silver is physically bulkier and more expensive to store per dollar of value. Think about it this way. $1 million worth of gold fits in a briefcase. $1 million worth of silver fills an entire room. Vaulting costs are higher, which gets passed on to shareholders through a slightly higher expense ratio. SLV tracks the LBMA silver price, which is the globally recognized benchmark for silver pricing, and it trades on the New York Stock Exchange with solid daily volume. Now, here's something I need you to understand about SLV that makes it fundamentally different from GLD as an investment experience. Silver is volatile. And I do not mean a little volatile. I mean buckle your seatbelt, check your portfolio twice a day volatile. In 2025, SLV's underlying silver holdings surged over 100%. But in a single week in March 2026, silver dropped over 10%. The 52-week range for SLV has been roughly $26 to $110 per share. That is a wild swing. Gold, by comparison, is far more stable, with GLD's 52-week range being roughly $272 to $510. If you are the kind of person who panics when your investment drops 20% in a week, silver ETFs will test your emotional limits. But that volatility is also why silver can deliver outsized returns during bull runs. It is a double-edged sword, and you need to be honest with yourself about which side you are comfortable holding. All right, now let us talk about the part that everybody ignores until tax season, and then they are sitting at their kitchen table with their jaw on the floor. Taxes. This is genuinely one of the most misunderstood aspects of precious metals investing, and getting it wrong can cost you thousands. Here's the deal. The IRS classifies gold and silver as collectibles. Yes, the same category as rare comic books, vintage wine, and antique furniture. And collectibles have their own special, and by special, I mean painful, tax rate. If you hold shares of GLD or SLV in a regular taxable brokerage account for more than 1 year, your long-term capital gains are taxed at a maximum federal rate of 28%. Compare that to stocks, where the maximum long-term capital gains rate is 20%, or even 0% if your income is below certain thresholds. That 8 percentage point difference might not sound like a lot, but on a $50,000 gain, you are paying an extra $4,000 in taxes just because the IRS decided gold is more like a painting than a stock. And if you hold for less than a year, short-term gains are taxed at your ordinary income tax rate, which can be as high as 37%, same as with any other investment. So what is the smart move? Hold your gold and silver ETFs inside tax-advantaged accounts whenever possible. Your Roth IRA is the absolute best place for GLD and SLV because gains inside a Roth grow completely tax-free and come out completely tax-free in retirement. You never pay that 28% collectibles rate. If your Roth is maxed out, a traditional IRA or 401k is the next best option because gains are tax-deferred until retirement. Only use a taxable brokerage account for precious metals ETFs if you have already filled up your tax-advantaged space. And here is a fun fact. This exact same 28% rate applies to physical gold and silver too. So the ETF does not make your tax situation worse. If anything, the ETF makes record-keeping easier because your brokerage handles all the cost basis tracking automatically. Try calculating the cost basis on gold coins you bought from 3 different dealers over 5 years. It is a nightmare. Now let us get practical. How much of your portfolio should actually be in gold and silver? The general consensus among financial advisors is that a 5 to 15% allocation to precious metals is appropriate for most investors. Ray Dalio, the legendary hedge fund manager, has publicly recommended up to 15% in gold. If you are younger, say under 40, and focused on long-term wealth building, 5 to 10% is probably sufficient. You want the bulk of your money in diversified stock index funds because stocks outperform gold over the long run. The S&P 500 has delivered roughly 10.7% annualized over the past 30 years, while gold has averaged around 8%. But gold and silver are not in your portfolio to beat stocks. They are there to protect you when stocks are getting destroyed. During the 2008 financial crisis, the S&P 500 dropped 37%, while gold went up about 5%. During the market chaos of early 2026, with geopolitical tensions rattling global markets, gold has been up roughly 15 to 18% year to date, while the S&P 500 is barely up 1%. That is the insurance policy working as designed. You do not cancel your car insurance because you have not had an accident. For the split between gold and silver within your precious metals allocation, a common approach is 70% gold and 30% silver. Gold is your anchor, your stability, your sleep-at-night metal. Silver is your turbocharger, your upside kicker, the position that might double while gold goes up 30%. If you are more conservative, go 80-20 in favor of gold. If you are more aggressive and can stomach the volatility, 50-50 gives you maximum exposure to silver's explosive upside potential. Let me put some real numbers on this to make it concrete. Say you have a $100,000 portfolio and you decide on a 10% precious metals allocation, split 70-30 between gold and silver. That means $7,000 in GLD and $3,000 in SLV. At GLD's current price of roughly $413 per share, that buys you about 17 shares. At SLV's current price of roughly $62 per share, that buys you about 48 shares. Total annual fees? GLD charges 0.40% on $7,000, which is $28. SLV charges 0.50% on $3,000, which is $15. Your total annual cost for precious metals exposure is $43. That is less than a single month of Netflix. Now compare that to buying physical gold and silver worth $10,000. You are looking at a purchase premium of $200 to $500, annual storage and insurance of $150 to $300, and when you eventually sell, another 1 to 3% in dealer spreads. Over 10 years, the ETF route saves you anywhere from $2,000 to $5,000 in friction costs alone. Here is something else the ETFs give you that physical metal cannot. Rebalancing. Say gold has an incredible year and your $7,000 GLD position grows to $10,000. Now your portfolio is overweight gold. With an ETF, you sell a few shares in 30 seconds, move the proceeds into stocks or bonds, and you are back in balance. Try doing that with a gold bar. You would have to find a dealer, negotiate, ship the bar, wait for settlement, and reinvest. It could take weeks and cost hundreds. Portfolio rebalancing, the simple act of keeping your investments at their target percentages, has been shown to add meaningful returns over long time horizons by forcing you to sell high and buy low. ETFs make this trivially easy. Physical metals make it nearly impossible. I want to address the one legitimate argument for physical metal over ETFs because I want to be fair. The argument is counterparty risk. When you own physical gold, you own gold. Period. Nobody can freeze it, default on it, or hack it. When you own GLD or SLV, you own shares in a trust that holds metal on your behalf. If the financial system completely collapses, your ETF shares might theoretically be at risk in ways that a gold coin buried in your backyard is not. This is a real concern. But let me put it in perspective. If the global financial system has collapsed to the point where HSBC and JP Morgan are failing, stock exchanges are shutting down, and ETF structures are breaking, you have much bigger problems than your gold allocation. You are worried about food and water at that point, not your brokerage account. For 99% of scenarios, including severe recessions, high inflation, crashes, and even regional wars, ETFs function perfectly fine. The 1% scenario where physical metal wins is the zombie apocalypse. And if that is what you are preparing for, you need a bunker more than you need this video. Let me wrap this up with the actual playbook. Step 1. Decide on your allocation. 5 to 15% of your total portfolio in precious metals. Step 2. Split that roughly 70-30 between gold and silver, adjusting based on risk tolerance. Step 3. Buy GLD for gold and SLV for silver, prioritizing your Roth IRA first, then traditional IRA or 401k, and only using a taxable account as a last resort. Step 4. Rebalance once or twice a year to keep your allocation on target. And step 5, forget about it. The whole point of passive investing is that you do not need to watch gold prices every day or predict what the Federal Reserve will do. You set your allocation, buy your ETFs, and let time do the heavy lifting. Gold has been a store of value for over 5,000 years. Silver has been used as money since at least 600 BC. These metals are not going anywhere. But the way smart investors access them has evolved dramatically. You no longer need to drive to a coin dealer, pay a premium, lug metal home, buy a safe, pay for insurance, and pray nobody breaks in. You can own the same gold and silver, backed by real physical metal in the most secure vaults on the planet, for the cost of a couple of pizzas per year. GLD and SLV are not sexy. They do not promise 10x returns, but they give you clean, liquid, low-cost exposure to two of humanity's oldest stores of value. And sometimes, boring is exactly what your portfolio needs.